Welcome and thanks everybody for joining us today for our webinar on the rise of life sciences in the age of patient capital. You may know that this is the second in our series of patient capital themed webinars that we're running this year. Last week, my colleague Karina looked at build to rent, myths, realities, challenges and opportunities. If you missed that and you'd like to see it, it was a really good session. And it is available on our patient capital landing page, which is at the Mills Reeve website, so do check that out. And this time next week, we've got a further session where my colleague Caroline will be looking at reflections and predictions on patient capital market. She'll be joined by Andrew Bickerdike from Turley and Charles Staveley from Mills Reeve, as well as Nigel Hugel from Urban and Civic. So that promises to be a really interesting session, and hopefully you can join us for that. A couple of quick items of housekeeping before we get started, if that's okay. Firstly, just to let you know, we are recording today's session, so if you'd like to watch it back again or share it with colleagues, we'll circulate it after the event. We will be running a question and answer function, so you should see at the bottom of your screen there's a box where you can drop any questions, so do stick any questions in there and we'll try to answer some of those towards the end of the session. And finally, just to say that when we've finished and you log out, there will be a questionnaire just to ask for any feedback. If you're able to provide any feedback, that's really helpful. It just helps us to tailor content for future events and make sure we're delivering things that you're interested to hear about. So having dealt with those few items, I'd like to introduce you to the panel. So my first guest today is Vincenzo Maggio. Vincenzo is a partner in our real estate team and heads our real estate life sciences practice. He advises life sciences investors, developers and occupiers, and some of his key clients include Trinity College, Cambridge, who amongst many things obviously own the Cambridge Science Park, Autolus Therapeutics PLC and Cadan's Science Partner. Some recent highlights for Vincenzo include advising Cadan's Science Partner on the acquisition of the Sherard building at the Oxford Science Park and also Brandon Road within London's Knowledge Quarter. So morning, Vincenzo. My second guest is Liam Nicholls of Creative Places. Liam is a chartered surveyor and partner at Creative Places and a specialist in investment development and asset management of R&D intensive locations, particularly interested in the life sciences sector. Some of his key clients include Oxford Properties, Derwent London, Cadan Science Partner and British Land. So good morning, Liam, and thank you for joining us today. So we'll jump straight into the questions. Liam, perhaps I could start with you. I think it would be fair to say that probably barely a day passes without some new life sciences deal featuring in the press. Last month, the Mayor of London approved developer CIT's application for a major life sciences-led mixed-use development at Vinegar Yard at the Biomedical Hub on the London Bridge campus. And speaking just a couple of days ago at the London Tech Week, the Chancellor praised the UK's extraordinary distinctive strengths in life sciences. With that in mind, why do you think we're seeing so much interest in the life sciences sector at the moment? And perhaps what's driving that interest?
Thanks, Tom. So it's a very exciting time in the life sciences sector, as you've alluded to there. And in terms of investor interest, that's kind of been driven by a perfect storm of factors that have occurred really starting about 2 years ago, just at the very beginning of the pandemic, although the seeds were kind of there pre-pandemic. But it's a combination of the life sciences sector in the US having been very much the darling of returns and real estate investment. And so a lot of that weight of capital in the US is then looking further afield to be able to place that capital. And that's come at a time where simultaneously the fundamentals of the sector in the UK, the occupational story, particularly in the more mature markets like Cambridge, have really come to the fore, based partly due to increased VC funding, but also really due to sort of structural changes around the health of the population in general, aging population, so the requirement for more medicine effectively. Coupled with that kind of in vogueness that the pandemic brought to the life sciences sector. So if you'd have counted the number of people that knew as a household name AstraZeneca, Pfizer, J&J, Moderna before the pandemic versus after the pandemic, the zeitgeist is very much there around that being something that's investable. But when those investors then look at that occupational story, they realize that there's a market there for them to explore, which really is relatively immature in the UK. So it's very much seen as a growing market. And then the final piece really has been, I think, a bit of nervousness driven by the pandemic around office stocks. So a lot of investors that previously would have been more traditional office investors basically wanting to turn their hand to something where there was more resilience. You can't work from home in a laboratory, or at least you can't do all of your time at home from a laboratory. So there's a resilience around that you wouldn't necessarily get from office property. And those occupational factors combined with the sort of weight of capital that's around for the kind of stock have led to that narrative. And that's why you're hearing so much about it in the press.
Thank you. And I suppose perhaps the other theme to this webinar is patient capital, by which we mean investors taking a longer term view in terms of seeing a return on their investment. Probably the most patient of patient capital investors would be something like a university or an Oxbridge College endowment fund. Perhaps a question for Vincenzo, if I may. What role have university and college endowment funds had to play in shaping the life sciences real estate sector?
Good point, Tom. I think initially academia's involvement in life sciences through science and technology parks probably came about by the fact that they are an academic institution. So it was around the research and development and basically supporting that kind of entrepreneurial and innovative demand that was there. So I think if you look at something like Cambridge Science Park, which you mentioned at the outset, which was probably the original science park, came about in the 1970s, early 1970s, following a Labour initiative in the mid-60s, where Whitehall was urging UK universities to effectively expand their contact with technology transfer. And you can say similar stories around the Oxford Science Park in the early 90s, with Magdalen College being there to effectively support discovery and innovation. And Liam makes a good point around, in more recent years, it becoming slightly more in vogue. So what we've seen is a number of the universities enter into these strategic longer-term partnerships with, for example, Trinity College and its quasi joint venture with Tufts Park, or Oxford Science Park, and their, in quotation, sale of a 40% stake to GIC. But we see that with other entrants. So Manchester Science Park, and its one of its stakeholders is the University of Manchester, University of Birmingham, joining up with Bruntwood SciTech, Edinburgh Bioquarter, and the investment from the University of Edinburgh. So what we've got there is this ideal scenario where we've got that criteria of pharma basically working alongside academia to present the space, the science and technology part, which is particularly attractive to those life science companies. And then, because of the points that Liam has just made, it being an investment opportunity for the academic institution itself, whether that's just making the land available and or putting in capital itself, as well as looking to other investors to provide some of that capital.
Thanks, Vincenzo. And Liam, perhaps kind of saying with this theme of patient capital investors, what other kinds of patient capital investors are putting their money into life sciences, and how is that changing? How has it changed over recent years, do you think?
So I suppose it's worth pointing out that very few investors describe themselves as inpatient capital. And so it has to be noted that the term patient capital means a lot of different things to a lot of different people. But I think really the shift from private equity money into more institutional money for the platforms shows that really we can see there being sort of grades of patient capital. So the colleges and the universities are taking a very, very long-term view, probably longer than any other kind of investor. But then moving into a kind of second bucket is going to be the more traditional pension fund institutions that and Everlast funds. So Brockton Everlast is a good example there, where they're sort of, forever owners, potentially, even if the pension fund investors run their cash flow for when they're buying a property on, say, a 10 or 15-year IRR, I really think that they're looking at the long-term aspirations for those locations. And so that shift from the sector having been really sort of slightly more opportunistic to having been well invested and sort of coming of age and being seen as an institutional asset class has led to this influx of what we'd refer to as more patient capital. And that's evidence when you look around the UK at the various different investors moving into the sector. Oxford Properties, Brockton, you've also got Royal London having recently bought on the Oxford Science Park, GIC. All of these are institutions really that you're going to describe as patient capital. It's more the institutionalization of the capital in the market as opposed to it really being more of a sort of business-driven opportunity that people were underwriting on the basis of, the fact that they could sort of perceive an edge to be got by getting in early. Those days really are now sort of coming to an end, and it's becoming an asset class in its own right.
Thanks, Liam. And I suppose, so what's kind of attracting this institutional interest in this sector? Are there specific things that are attractive to institutional investors in this asset class that perhaps weren't there before?
So it's going back to really the first question as to why are you seeing it being sort of in the property press, etc. If you look at the fundamentals for a sector as a whole and how resilient it's going to be, the life sciences sector is really dealing with problems that are not going to be going away anytime soon. So the research and development markets in general, not just the life sciences, tend to be less cyclical because product development takes a long time, and because occupational demand can be based on factors which are not as cyclical as you would see in sort of the financial institutions, etc. So as an asset class, research and development tends to have a greater resilience, and the data that is coming through, particularly around VC investment in London, VC investment into Oxford and Cambridge, is very strong. You've got to then couple that with the realization that as open innovation is becoming the methodology for people to conduct research and development, and people are wanting to embed themselves as research and development occupiers in urban innovation environments, that the academic strength of the UK, particularly in the Golden Triangle of Oxford, Cambridge and London, is very, very good. So, Oxford and Cambridge University, UCL, King's Imperial, are all consistently very highly ranked, particularly for the life sciences. So if you're sort of wanting to future cast out to see where is going to be somewhere that's going to be a good market for this into the future, those investors are looking at that non-property but very much relevant data, and then using that as a way of extrapolating to see where would be a smart place to invest into the future. And that's really why you're seeing these institutions sort of look at that data. And right, there's not reams and reams of property information to be able to hang your hat on, but there's a lot of underlying data that leads them to believe that this is a good thing to invest in for the future.
I think Liam makes a really good point there about this idea of the locations starting to emerge in urban locations, and that idea of a co-working cluster. We're seeing the emergence of new clusters. I know one of the participants has asked a question as to what the key criteria is for a life sciences location, and probably won't get into the details of that today, but traditionally it has been that association between life sciences with the academia, which then has a kind of a boost on startups and productivity. But we are starting to see kind of new clusters emerging, like in White City, the former BBC building and its proximity to Imperial College and their iHub building. So it isn't a case that we could just put a pin anywhere in the UK and decide that's going to be a new life sciences location. But as Liam says, I think it's the appreciation and the understanding of what makes a key location and trying to spot that as it emerges.
Yeah, it's that urban innovation district concept where you've got good transport links, good access to early stage research from academic institutions, and a plethora of other like-minded businesses which you can spark off. And the model of being able to buy in, spin out, all of so open innovation is a coined term that has been sort of in circulation for a long time in the R&D community, but the property market's only really now sort of learning to understand it properly. But that sort of being in the mixer is really what it's all about. And at transport nodes where there so happen to be good, strong universities, that's kind of the sort of special sauce, I suppose, for being able to create those urban innovation districts.
Thanks, Liam. That's and Vincenzo, that's really interesting. So we talked a bit about what the opportunities are and why they're so attractive. What, perhaps again a question for Liam, but what challenges are investors facing when they're looking for these investment opportunities in this sector?
Well, at the moment, the key challenge is stock availability and therefore competition. So we talk to investors all the time, and all of these investors will say, we want to invest €1 billion, $1 billion, £1 billion, whatever it is. It always seems to be $1 billion. It seems to be $1 billion. But the problem is that in the UK, to get opportunities of scale, they are relatively few and far between, just because of the simple constraints of availability of stock. And so what that means is that when stock does become available, it's highly competitive. So we're seeing quite a lot of parties sort of have a couple of warm-up rounds of trying to buy something, and then they're sort of getting third time lucky once they sort of get into the groove of what the trajectory in terms of pricing is. So that's a key issue. The second issue is really the lack of transparency in very quickly changing markets, because the occupational demand story is so strong in places like Cambridge. There's been lots of rental growth. And so to understand that, the parties need to be very well advised of what the trajectory around rents is going to be, and also understanding what is forming that ecosystem of activity that's meaning that those occupiers want to be there. And that can be quite difficult to get to without quite a lot of knowledge. And that's kind of married with a lack, particularly in London, of property data. So because it's a very quickly expanding but very immature market, to a certain extent even in Oxford, but particularly in London, you can't go and find a sort of quarterly snapshot report to work out what the demand for life sciences space is going to be in London. You're having to rely really on a lot of the underlying data to then extrapolate out and work out what demand is going to be. Often companies will get to investment committee stage and there's nervousness then, because actually, are we really wanting to part with money for something where there isn't the usual property data that we see in the office market, in retail and logistics? So that they would be the challenges. And then the other one at the moment is really build cost inflation. So because we've got build cost inflation that's running at levels which is sort of unprecedented in my career, that means that being able to pin down, particularly on development opportunities, a particular price that you're going to pay is more challenging. That doesn't seem to have caused a massive tempering in terms of pricing at the moment. But people are definitely having to be a little more cautious in terms of contingency in their appraisals now because of that particular metric. So they're the key challenges that we'll be seeing at present.
Thanks, Liam. And perhaps thinking particularly about the types of investor and looking ahead over the next few years, do you see that there might be other new types of entrants to this sector?
Well, there's been a lot of new entrants to date, and I think most investor types are now covered. So we've got sovereign wealth, pension funds, historic universities, private equity. They're all in the mixer. I think what we might see going forward is that as the stock becomes more mature, there's going to be more stock with income on it, and so you'll start to get income-driven investors looking at opportunities that have been developed out where they are potentially going to be sold. Although generally the story tends to be once you've got your hands on something like this, you're actually going to want to keep it. I think the answer is that actually we've probably gone through that shift a little bit, and that because it's become more institutionalized, and because we've got more of the traditional investor groups, REITs, traditional London developers, etc., looking at the sector, that moment's kind of passed, and what we're more going to see is kind of a settling, amalgamation, JVs, that kind of thing happening into the future, rather than necessarily there being a whole new raft of investors coming in. New investors don't get me wrong, new investors are coming in all the time, but they tend to be of the same ilk as another 3 or 4 that we've already got looking at the stock.
I think that's a good point, Lee, and that the type of investor is probably starting to settle. That the identity of the investors is still changing, but the nature of the investors is probably settling a bit more, that it's not predictable, but we're probably less surprised by the entrance of X, because we've now starting to see some trends in a relatively new sector.
Thanks, Vinny. I think that sort of neatly takes me on to what I was going to ask about next. Perhaps a question more for you. I'm interested in a bit to hear a bit about how these deals are structured, perhaps in terms of commercial terms and legal structures. Is there anything that we're seeing that's different to the life sciences sector transactions, perhaps by comparison with more mainstream investment real estate assets?
Liam's certainly more qualified to talk to commercial terms, and we won't get into the weeds on legal structures, but kind of helicopter view, if you look at this asset class in comparison to maybe some other investment asset classes, I think the amount of capital that's needed is, casts its shadow over the deals themselves, whether that's, as Liam has mentioned, the increase in build cost anyway, but as an asset, it was always at the higher end kind of construct. A typical occupier's fit out is going to be significantly more expensive than an office user's fit out. So there's a bit more opportunity around that. There's probably a little bit more integration between your traditional landlord and tenant type of scenario, but the ramification then is looking at lease lengths, for example, and how you kind of balance between the need for a lease length that as the investor you're going to see your return, with an occupier where on occasion can be quite a precarious, it's dependent on clinical trials, and so I think the investors have had to kind of, maybe the newer investors have had to get their heads around the type of tenant and how you profile that in comparison to the traditional, especially in the case of the startups, where it could go from zero to hero quite quickly, or actually the other way in the same way. So I think structure wise, it's still a landlord tenant relationship. The leases look slightly different because of the capital costs, and then around the investment side, we are seeing, and I'm not saying that this is uniform, we are seeing more deals in the more recent investment market where there's that rent sharing between landowner and investor. And I think part of that's just symptomatic of that strategic longer term investment that's being created, that almost a side-by-side arrangement. I don't know, Liam might chip in and tell me that everything I've just said is wrong.
No, I don't think it's wrong at all. I think the fact that you have more specification complexity makes for a more complicated deal structuring process, and that you really need an overarching view and a really integrated professional team to be able to develop this stuff out. including being integrated with your legal team early doors, because you want to make sure that you're structuring the leases that you're putting in place to conform with how the build contract's working, and there's more moving parts than there would be to do a Cat A office fit out, basically. In terms of the structuring of deals on the investment side, Vinny's completely correct that you see more long leasehold deals in this sector. That's really to do with partnership between long-term landowners and the investors that are coming in, sometimes because of actually academic collaboration. So if you're a university, you want to retain an element of control over the land and make sure that you've got gateway policies, and that you're basically, if you're putting the hard yards in terms of creating an ecosystem and sharing your knowledge of the companies and collaborations and whatever else, you want to create a return from that effort. So that can be part of it. And then the other thing is, if you've got landowners that sort of want to invest in the sector but don't really want to put the capital in to do full-on development risk, then it's a nice easy way for them to be able to capture some of the value going forward. So that tends to be more of the case. What's interesting from a sort of commercial perspective is that actually the investment yield profiles that would usually be shifted out for long leasehold interests, particularly if you're getting one with a really good party like a university, can actually be seen as beneficial rather than detrimental. So that's quite an interesting dynamic you see in this market that you might not see elsewhere.
Thanks, Liam. That's really interesting. But we are sort of running slightly short on time, so I was going to ask one last question, maybe just a really short answer, if that's okay. It can be one word if you want. Do you think the level of growth that we've seen in the life sciences real estate sector is sustainable over the longer term?
If that's directed to me, I definitely think that the sector, so it's exploded, right? So the way that we've seen it move from being a secondary asset class, not really being considered as an asset class in its own right, has created yield compression, and that yield compression can't happen twice. So we can't rely on the fact that yields are going to keep coming in to prop up the prices of real estate in the life sciences sector. That's kind of happened. In terms of rental growth and supply and demand for laboratory accommodation in our markets like Oxford, Cambridge, London, even further afield in cities like Manchester, etc. I think the fundamentals that are backing up those investment decisions are sound. The research you can do into the quality of the academic activity, the quality of the companies and the innovation districts that we're looking at, and the fundamental problems that they're solving are not going away. So yes, there could be fluctuations due to changing investments in the life sciences market. We've seen that there's been wobbles around biotech investment of late on the NASDAQ and whatever else, but I don't think that is fundamentally changing the fact that we've got these big problems that we need to solve, and the way that we're going to solve them partially is with laboratory space. So that's not going anywhere anytime soon.
Thanks very much, Liam. That's really helpful. So that is just about all we have time for today. So just a very quick reminder that we are running another session same time next week on reflections and predictions on patient capital market. We will circulate details with that after this webinar. So if you're able to join us for that, please do. And a final reminder that when you do log out, please do take the time to feedback on this webinar if you're able. So that just leaves it to me to say thank you to our two guest speakers, Liam and Vincenzo. And thank you to everybody who's dialed into the webinar today. I hope it's been useful, and we look forward to seeing you at the next one. Thanks very much.